everybody? It's the Blockchain Raccoon keeping you updated with the latest cryptocurrency news and analysis. I hope you all had a fantastic weekend, and I did. But I spent some time talking with friends and family about, taxes, cashing out, how I'm taking some profit, and how this is all going to play out with taxes. Because eventually, everybody here is going to need to find the right time to cash out from this bull run. But before we reach that point, we all need to think about how we're going to deal with crypto taxes. Because if you sell for a gain, Uncle Sam will most definitely want his cut. And while our cryptocurrencies may not physically exist, the tax payments that we're going to be paying on this definitely exist. And we just need to figure out how to minimize your crypto taxes so you can keep more of your money and maximize your gains. To do this, we need to first kind of have a basic understanding of how crypto gains are taxed. Then you can start thinking about ways to reduce or eliminate your tax bill. Hopefully, this video will help us get a better understanding of how crypto taxes work so we can get ahead financially. Alright, so crypto taxes are taxed on cryptocurrencies because cryptocurrency is actually considered a property for federal income tax purposes. And for the typical investor, the IRS treats it as a capital asset. As a result, crypto taxes are no different than the taxes you pay on any other gain realized on the sale or exchange of a capital asset. So keep that in mind. So when you purchase a capital asset, be it stock, bonds, a house, Dogecoin, Bitcoin, XRP, or whatever, you establish a basis equal to your cost to acquire it. But when you sell, you compare your sales proceeds to the basis to determine whether you have a capital loss or a capital gain. If your proceeds exceed your basis, you have a capital gain. If reversed, you have a capital loss. Sometimes if you're going for a lot of money, you want to play around, you can actually purposefully take a capital loss to help minimize and offset your taxes. But, make sure you know what you're doing. Now, you're also going to need to consider the time period for which you held the asset. Depending on how long you hold your cryptocurrency, your gains or losses will be considered short-term or long-term. Now, that distinction will also play a huge role in how much you have to pay in your crypto taxes. Alright, so short-term capital gains and losses. When you buy and sell an asset within a 365-day period, you recognize a short-term capital gain or loss. Short-term gains are subject to the same tax rates you pay on ordinary income, such as wages, salaries, commissions, and other earned income. The IRS has 7 tax brackets for ordinary income ranging from 10%, 37%, and to 37% in 2021. Now, long-term capital gains and losses. If you buy an asset and sell it after a year, the difference between the sale price and your basis is long-term capital gain or loss. You'll actually pay less tax on a long-term gain than a short-term gain because the rates are generally lower. Currently, there are 3 tax rates for long-term capital gains: 0%, 15%, and 20%. And the rate you pay depends on your income. Alright, so let's look at how to minimize your crypto taxes. Now that we have a little bit of knowledge about crypto taxes, which is really just another way of saying capital gains tax, you want to set a strategy to minimize how much you're going to pay the IRS. So let's look at some useful tips to reduce our tax bill. Now, you want to make sure that you hold until your short-term gains turn into long-term gains. It can be kind of hard to do, especially if you're trading. I'd hate to see that. Now, different capital gain rates will apply depending on how long you own crypto. If you want to lower your tax bill, hold on to your cryptocurrency long enough to turn your short-term gains into long-term gains. This may not be an easy task, but if you have the patience and fortitude to keep your crypto for at least a year before selling, then you're gonna pay a reduced tax rate on any capital gains. So let's take an example. Bob. Bob is a single taxpayer earning $70,000 in wages for 2021. Bob also has $5,000 in capital gains from the sale of crypto. If the gain is a short-term gain, Bob will have $75,000 of ordinary income. After claiming the standard deduction, that leaves Bob with $62,450 of taxable income, which puts Bob in the 22% tax bracket and results in a tax bill of $9,488. However, if the gain is long-term, the $70,000 of ordinary income minus the standard deduction is still taxed in the 22% bracket. But the $5,000 of capital gain income is only taxed at 15%. That means an overall tax of $9,138 and a savings of over $350 for Bob. So Bob made out. And we can also offset capital gains with capital losses. Now, a strategy for lowering your crypto taxes, if you're an investor, you pay is to offset capital gains with capital losses. This works by subtracting losses on crypto assets that you sold during the year from taxable gains on cryptocurrencies or other investments that have appreciated in value. But be warned, you face limits when using this strategy. When you recognize investment losses, you first must offset losses of the same type. For example, short-term losses first reduce your short-term gains, while long-term losses lower your long-term gains. After that, if you have a net loss of either type, you can use them to offset the kind of capital gain. For example, if you have excess short-term losses, you can apply them against any remaining long-term capital gain. If you still have a net capital loss available, you can use it to lower your ordinary income. However, when pursuing this strategy, you can only use up to $3,000 of capital loss to lower your ordinary income in any given year. The remaining balance rolls forward to the following year to offset future gains or lower your ordinary income by up to $3,000. Another way, number 3, is sell in a low-income year. When waiting for your crypto gains to convert from short-term to long-term, you might also consider timing this perfectly, choosing to sell in a low-income year. So selling in a low-income year can help with taxes on both short-term and long-term gains. If you have short-term gains, which are taxed as ordinary income, you won't have as much other income added onto that, and that will push you into a higher tax bracket. For example, if you sell short-term assets when you retire and are no longer collecting a wage, your tax bracket could be based entirely on the income from your short-term gains. If you have long-term capital gains, a lower overall income for the year can mean a lower tax rate on those gains. That's because the long-term capital gains rate that applies to you, either 0%, 15%, or 20%, is based on your taxable income. So if you have less taxable income, you are more likely to have a lower long-term capital gains tax rate. Also, if you choose to retire early and have accumulated enough cash to fund your living expenses until you can withdraw funds from your retirement accounts, you might have little to no income during the year. If so, this is a perfect time to lock in long-term capital gains and possibly pay a 0% tax rate. That's bullish. Alright, so you can also reduce your taxable income. Closely related to selling your appreciated investments in a low-income year, Another tried and true tax minimization strategy involves lowering your taxable income. This means scouring the tax code for tax deductions and credits that can bring your taxable income down. For example, you can take care of expensive medical procedures, contribute to a traditional IRA or a 401k plan, put money in a health savings account, or donate cash or property to charity. There are plenty of other tax deductions and credits that you could qualify for. You might even want to start talking to a tax professional to help you uncover some other tax breaks. All right. We can also look at investing crypto in a self-directed individual retirement account. A good strategy to minimize your crypto tax bill includes investing in a tax-deferred or tax-free self-directed individual retirement account, an SDIRA. That way, you either pay taxes later when you conceivably have a lower taxable income in retirement, or upfront when you contribute to your Roth SDIRA because you have expectations of higher tax in retirement. You can also look at gift the assets to a family member. Depending on your goals for using your wealth, you might consider another way of lowering your crypto tax bill is by gifting your cryptocurrency to family members. Now, the IRS allows you to gift up to $15,000 per year, per person, without tax consequences. While the basis in the cryptocurrency transfers to the new owner, the recipient might earn a low enough income when they won't pay taxes on the appreciated property when sold. Or, at the very least, less taxes than you might have to pay were you to sell the cryptocurrency yourself. So, that's a possibility. Now, this strategy certainly plays into your broader estate planning goals and how you wish to transfer your wealth. This also makes it something that you should first discuss with an estate planner to ensure that it fits in with your overall plan. You can also donate your appreciated cryptocurrency to charity. Similar to gifting appreciated crypto to a family member, you might also think about donating your cryptocurrency to charity. Not only will this result in no capital gains tax, it can also trigger a significant tax deduction that you can claim on your tax return. So whether you donate an asset, you can claim the appreciated fair market value at the time of donation has a deduction against your taxable income. For example, if you own $50,000 worth of Bitcoin and choose to donate it to a charity you regularly support, you may be able to write this off as a charitable deduction on your return. Further, if the charitable organization qualifies as a tax-exempt 501(c)(3) charity, it won't need to pay capital gains tax when it sells the donated cryptocurrency later down the road. Now, another option you can look at is moving to a state with no income tax. I mean, there are state-level income taxes. Not surprisingly, your state has a vested interest in your investment gains as well. But, that's who wants to just up and move. But it all depends on what your goals and how much you're going to gain from all this. And you talk to a tax person about that. Now, there are a number of tax-friendly states who offer low or no income taxes. That means that you might pay taxes at the federal level, but you won't owe much to your state's treasury. If you can, consider moving to a low or no income tax state to reduce or even wipe out taxes on all types of income. These savings can add up and help you keep more of your crypto earnings. Alright, let's take a look out here at what they wrote down for me here. Bequeath it in your estate. I said bequeath it. Don't get Ron on me here. All right. Excuse me, folks. All right. So if we look at the final crypto tax minimization strategy, is to bequeath your crypto asset as part of your estate. So, depending on that down the road, none of us are getting out of this alive here. So when you pass away, the investment will receive a step up, i.e., increase in basis to its fair market value at the time of your death. This way, your heirs will not need to pay taxes based on your original basis when they sell the cryptocurrency they inherited. However, because cryptocurrencies carry significant volatility, depending on the virtual currencies you own, they could shoot up or down at any time. If this happens and the virtual currency goes to the moon, at least your heirs' tax bill won't be as large since they received the token with a stepped up basis. So, depending on how things are looking here, I'm looking into a broad range of strategies, and everything depends on the market. I'm looking at setting up a few different things, just trying to get my head around this and plan for the future. Because like I said, I'm in this for the long run to build generational wealth. And you gotta look long term. And so it's best to actually sit down with a tax professional to figure this all out. Especially if you're going to be having a lot of money. You definitely want to protect yourself and your family. So folks, I'm going to wrap this up by stating that I am not a financial advisor. Please do your own research on this. And I appreciate y'all, and thanks for tuning in.